Welcome back to Reimagine 2021. I'm Yonah Hochhauser, and today I'm glad to be joined by Rob Levy, co-founder and president of Hxro. Rob, thanks so much for joining us.
Thanks so much for having me.
Now, Rob, I'm excited to speak to you because I get to speak to a lot of different projects and companies that are in the crypto space, in the blockchain space, and in outside. And it's always exciting to talk to different industries. You work in an industry that I really enjoy and I'm really interested in. So I'm very excited to speak to you, and I'm sure our viewers will as well. So to start off, you want to give a little background, kind of what Hxro is and how you got into the game?
Sure. Well, my background is in the professional side of the trading industry. I was a market maker, and I might age myself a little bit here, but I actually, when I started going down to the exchange in Chicago, there were actually trading pits still, and thousands of people would go and trade on the trading floor in these big pits. So I learned how to be an options market maker. And the first half of my career was down at the CBOE. So we traded equity options or stock options. And being a market maker, a liquidity provider who kind of, I was forced to evolve from this open outcry, insane trading environment into the more electronic trading, and lived through this hybrid into where we are now, where it's virtually all electronic trading. So with that mindset and that experience, my partner and I, we jumped into crypto at late 17, early 18 full time. We took the plunge and, really immersing ourselves in experiencing the crypto markets, we realized that there was opportunity to build products that we had always dreamed of and actually put them out there for the community, for people to use. And that's really, it's that foundation in traditional market making and derivatives, and then making the jump. It really was clear to us that there was opportunity to build what we were dreaming of and put it out there pretty easily to the community, and then see what they thought. And that's how Hxro was born in mid 2018.
Yeah, and for those kids out there who don't know, trading used to literally be, they would just be chucking pieces of paper with trades. It was insane.
Trading was insane. And that when it was slow, people would take the trading cards and we'd actually throw them and try to get them into little buckets or hats when it was slow. And people were unbelievable, the skills that they would get throwing trading cards across a pit to your clerk. I mean, you'd be, and all this going on when people are yelling and screaming, but that's what that stressed me out when I was 18 years old and I first got down to the trading floor. I'm like, how am I going to keep all these cards? What if I lose a card? How, you're like, how is this actually going on with the manual trading cards, and you're trading and you got to keep a pen and write all of them. It seems archaic, but it worked for so many years. We forget about before everything was digital and Wi-Fi, there were wires everywhere. I mean, we had to actually jump over wires and stuff when that became big, where you were actually holding a computer, a mini computer in the pit. Like, you're talking about wires everywhere, no Wi-Fi. It was a different world, but things actually still worked back then. You'd be shocked.
Yeah. And so I wonder if it's the same way where, if you look back, how trading was, where it was all offline, it was all analog, and then it moved to digital, which I'm sure was a very crazy process in and of itself. And then now that we're seeing kind of this digital money going on the blockchain, and for many people, they think, well, they're scared. Whoa, this is a whole new technology. How are we supposed to put a whole financial system on this new digital technology? But we've already done that in the financial system. You've seen this firsthand. We've gone from kind of this offline analog financial system, financial trading, to now what is high frequency trading, bots, and all these things. So is it that big of a jump now to now be trading cryptocurrencies, to now do this whole new technology of blockchain?
It is a big jump. It is really a big jump. And it seems like such a drastic jump. But I think what puts it in perspective is that this jump actually has taken place over many, many years, right? I mean, for tens and over 100 years, you know, you think about the Chicago Board of Trade, which really was, at first, it was where people would congregate. There's like the Haymarket area of Chicago where people would come with the agricultural commodities, and Chicago was really in the heart of the farmland, right? So the corn, you drive 45 minutes outside of Chicago proper and you got cornfields, right? And soybean fields and wheat. Like, we are in the breadbasket. So this is where people would come together and trade their livestock and the grains, and then move it out to the rest of the country. So it was all a very personal exchange back then. And I kind of liken it to poker a little bit, right? Poker is a different game when you're sitting at a table with your buddies or with guys, and there's 5 of you or 6 of you or however many there are. You're looking at them, you're interacting with them. You can, you know, you read the room. You kind of know when your buddy's got a good hand because he gives you that little chuckle or he looks at his cards, and you know, you can see how everybody is reacting. And that very much was how trading in the pit used to be. I mean, these markets, they move. And when people have different positions on and they're making different trades, you can see how they're acting. You can see the brokers in the pit, right? When the broker would come in from Goldman Sachs and he'd be running into the pit and he'd ask you, how are these Amazon $200 calls? And you could see he's kind of shaking. You knew he had something to do, that he was either a big order or he needed to get it done. He really wasn't going to care about the price. So give a market fast and just tell him where he could do it. So you can really get a feel for what was going on. And that part of the game really transformed with electronics. Like playing poker online, which became very big, it's a different game. It's pretty much strictly the mathematics at work, right? And what your probability is. You're not able to read what the other person is feeling, thinking, and how they play. You can see it digitally, you can see what they do, but you're not feeling it. So it really was transformed into this personal, live industry, into now it's completely disparate and it's all electronic. So that part of it is a big deal. And what it also does is it means you don't have to be in one location. You don't have to call the broker who then has to go to the pit. It's all point and click. And so that progress took years for all the global exchanges to get all the systems in place. For a while, it was a hybrid approach, but it was a really big transformation. Didn't happen overnight. It took every bit of 20, 30 years to take place until finally, you know, when I got into the corn options pit in 2010, there were 225 market makers in there. And when I left to go off the floor for good in 2016, there were 8 market makers in there. So it was a really big transition, but that last little leg, it was pretty quick, and it didn't happen until recently, to where it was kind of like, all right, we really don't need the floor anymore. So
right. And that's why I enjoy speaking to, you know, real experienced traders like you, like yourself, who they're coming into the crypto space not just you know, with crypto eyes, but also with a real financial backing, a real financial understanding of how markets work, how assets are traded. And so I enjoy asking these questions, because the answers I get are going to be very different from someone who's just, you know, a crypto guy who's just excited about, you know, sticking it to the man. Now, we've seen that idea recently with this big rise in the perceived power of retail investors, with the, you know, famously with Wall Street bets and pumping up GameStop, it was AME movie theater chain, or AMC movie theater chain. And so, you know, as someone who comes from that more institutional and investor space, And we see this has only become this retail, let's say, uprising, I would say, really only came to be possible because of the technology, because of the communication technology that allows retail investors to kind of communicate and gang up together, but then also the access they have to the markets, to trading, to options, and there's more advanced financial tools. And we're starting to see something similar happen now with the rise of DeFi, decentralized finance. We're finally starting to see a really complex and advanced financial trading instruments that have historically not been in the hands of traders now being out there for everyone, whether for the good or bad. I mean, you have these advanced trading options that your grandmother who doesn't understand anything can now press a button and she doesn't know what she did. So
yes,
when you're looking at the space, clearly it's an unregulated, for the most part, it's an unregulated space, and regulation is there for the most part to protect consumers. Right. How is it now? Hxro offers trading services and other options and things of that nature. Is it the role now, because there is no regulation, is it the role of the industry for people like yourself and other service providers to self-regulate and try to explain to investors and educate them how to properly use these tools?
It is. I mean, regulation itself at its core is for protection. It's not an evil thing, right? It is for protecting really retail investors at its core. I think that the beautiful thing about crypto is the idea of access, right? Anybody can access pretty much any market without an intermediary. And that was really what kind of shook me to my core in 2017, was people that can they can register an account on Coinbase, on Binance, on Bittrex, on Poloniex, and they can access markets with instant settlement. They can access markets without going through an online broker. And it was, to me, transformational. Now, like you said, when you have instant access and pretty much uninhibited access, and that's changed. Now, me in the US, I can't get onto Binance.com and I can't trade the whole suite of tokens that they offer there. And it upsets me. I'm a pro, right? I've been doing this for over 20 years. I feel like I should be able to either check a box, I should be able to take a quiz, a test that shows I can trade these things, and fine. I'll indemnify. I'm not going to come back and ask for any damages or anything. I know the risks here, which is also kind of the accredited investor laws, which people they don't like. And there's an argument for both sides of things. But this, the universal access offered by crypto and the new technology is extremely, extremely important. And it is the future of where things are going. Now, you brought up, the GameStop, the Robinhood incident. And I think what it did was open people's eyes to still an archaic process that goes on with stock settlement, right? Why should it take 2 full days to settle a stock that someone buys in their account? This is 2021, right? Mm-hmm. I mean, we're literally sending text messages to friends who were seeing it in real time, thousands of miles away, yet it's taking 2 full days to settle the transaction. It's archaic. And it's not that it's so archaic, 10 years, 20 years, but it's just not where things should be. So we saw that Robinhood ran into a major capital issue. It's not that they wanted to lose the trust of their users and disadvantage the little guy at the expense of the big liquidity providers. It was that, according to the law, they needed to have a certain amount of capital, which ended up being $1 billion, $2 billion just for a 24 or 48-hour period of time. They needed to have a lot more funds than they did. And they had a decision to make. Do we want to continue to operate business, or do we want to say, okay, you can't buy these certain things anymore until we actually have a more equal distribution of buys and sells, and we have the funding. So crypto in and of itself is changing things, but the regulation, it needs to come to where the builders and the leaders don't feel like they're being handicapped, where they can build and still build at the speed with which they build. But it is the big players in the industry, they need to self-regulate. And even like the CBOE and CME, it was an SRO, it was a self-regulated organization. And yeah, there's FINRA, there's NFA and CFTC and all of that, but we need to self-regulate because there still needs to be protection for the individual. And there needs to be education. And that stuff is very important. That's why, we are along with Hxro, we offer Hxro Labs, where we really try to simplify and break down the education piece and talk about what is going on in this crazy market, because markets seem like they're crazier than ever. And I tend to agree. They are. Markets are, they are one of the most chaotic parts of life, actually, because it really mirrors human emotion and psychology.
Mm-hmm. Well, I mean, I think that's been one of the big knocks against the market recently, has been kind of this disconnect between the market and the actual economy, the actual, Main Street, and not just Wall Street, where, historically the markets were supposed to be it's just the public markets allow public equity, the public equity to these massive corporations. And it seems like as time has gone on, and maybe you could tell me better than I know. I don't really have a finance background, but there seems to be, maybe it was with the with the decoupling of the gold to dollar, maybe it was with the digitization, the speed algorithm trading and high frequency trading of the market. But it seems like the market has disconnected itself from the actual economy. The equities market, at least. I'm not familiar with the commodities market enough to speak about that, but do you agree with that statement? And if so, why?
I think that it's a lot of semantics, but I think what you're saying is true in that, but it is driven at its core by policy. And what we've seen in the last 10, 12, 14 years since the global financial crisis of 2007, 2008 is this real shift in monetary policy, right? We hear about QE, quantitative easing. We hear about the Fed and central banks globally, and what they have had to do to stabilize the crisis from 07, 08, which was fully global. It was not a US thing. I mean, this was global. There was the European debt. I mean, this is really a transformation that's gone on everywhere, in that they've needed to flood these markets with liquidity. The governments, the central banks have bought up all this debt, right? They're buying up not only government debt, which ends up bringing interest rates down, but they're buying up corporate debt as well, which brings this borrowing rate. It's almost like corporates can borrow almost an unlimited amount of money, just like the government, because the central banks are the ones that are backstopping it. They're providing the bid in the market. So you look at a company like Apple with $180 billion worth of cash, like they're sitting on cash, yet they enter the corporate debt market and they're issuing debt, because why wouldn't they? They're a player like anybody else. If they can borrow money at 1%, 1.5%, because their balance sheet is much more stable than even the US government's. I mean, they've got all this cash. So they're issuing debt. Why would they need to? Well, because that's the system right now. And they can play just like anybody else. But this QE, the monetary policy of low rates, 0% interest rates, negative interest rates on 15, 20 trillion dollars worth of funds globally, what that does is it pushes people out on the risk curve. You need to go put your money elsewhere to look for yield. And that basic idea drives people into the riskier corners of the market, which, yes, can dislocate what we would think would be valuations of assets and can cause real spikes in price. But who are we to say that it's wrong? You know, why was it wrong that GameStop would trade $200? Well, it's wrong because their business was not doing well. They're on the verge of bankruptcy. They weren't making any money, but the market, it acts in a certain way that it is a free market. And if people are going to put their capital up, you can pretty much do whatever you want in this market, but your capital is at risk to lose as long as you're not manipulating anything. So it seems like a chaotic place in the markets right now, but this policy is driving it at the core. And when you have zero rates, lower for longer, it drives people into the risk assets and it pushes prices higher. And that's what we're seeing pretty much. And quite frankly, I don't think global central banks have a viable strategy yet to unwind this policy. So I don't think this is ending anytime soon, which is going to be quite interesting, and which is leading people into more scarce assets like Bitcoin.
Well, I mean, I do think that this has played, as bad as it is for the world economy, has played right into the hands of, crypto lovers and adopters like myself, who for so long, this is where Bitcoin was born out of. It was born out of the global financial crisis. The white paper came out in 2008, I believe. And it was based off this idea of, hey, we want a limited supply. If you look at central banks, they're printing money, and we've always been saying this, but I think that people recently are finally realizing, because of the magnitude, historically institutions and the central banks and institutions have been conservative. They've printed a little bit when they need to. They've cut it back a little when they need to. They're aiming for that 2% inflation. They're aiming for that unemployment rate. But it seems like they've really just gone off the walls and printed like crazy. I believe it's more money printed in the last year than all of history, or something crazy like that. But what this has done, and like you mentioned, essentially, why would I keep my money in the bank where I have no interest? And it's made people look for riskier but bigger returns than they could find in their bank. And this has led into the hands of cryptocurrencies. And Bitcoin is perfectly suited for that. Limited supply. There's no control over the supply there. So do you think that that this is, let's say they do figure it out. Let's say the central banks somehow magically pull it a rabbit out of the hat and are able to actually, erase all that debt or bring it back to normal levels, because, debt is okay. Debt isn't always bad, but certain debt is okay.
Yeah.
Let's say they're able to actually normalize it and stabilize the market, bring it back, inflation rates go back to regular. Will we see kind of, all these people who did jump into the crypto markets for that bigger rewards leave, or are the gains that we've made here to stay?
It's a great, really, really great question. I think, the thing that we always have to ask ourselves is, when that day comes where they are able to normalize the policy, where will we be then, right? Will Bitcoin be $500,000 then? And then we normalize and we see a pullback to 200,000, 250, 100,000. It really is important to think about where we're going to be, because markets, there's always a push and pull, and every action has a reaction. And I'm I'm from the Chicago area. I grew up trading in the agricultural markets. We're like the global center of that. So I kind of think about it as, let's think about the grain markets, right? Corn, wheat, and soybeans, the three main grains that globally people grow and trade. Let's say the price of corn skyrockets because there's a bad crop somewhere. And then that next year, because corn is so elevated relative to other things, more and more people plant corn, right? So as we start to find out, holy cow, everybody's planting corn this next year because the price is so much higher than wheat and soybeans. Now, all of a sudden, the corn price craters, and that next year after harvest, we've got a ton of corn, but we don't have as much soybeans and wheat. Now we're a little short there. So then people start to plant more wheat and soybeans, and now things regulate, prices shift, they normalize. That's how these markets really work when we think about Bitcoin, gold, the dollar, euro, yen, policy by the big players and the central banks everywhere. It affects everything else. And this isn't just about the dollar, right? This is about fiat currencies in general. The dollar just happens to be the biggest, nicest house on the block when it comes to fiat currency right now. It used to be the pound, right? Or the yen went through its time. We've got the Chinese renminbi. There are currencies that they're all playing within this ecosystem, and policy that is put into place in different countries, it affects everything else. So this isn't just about the dollar. I look at it as fiat, where the dollar makes up a big part of it. And we look at the dollar index. Everyone looks at that. That's how the dollar is trading against all the other currencies. But I look at it as kind of like the fiat index, where the dollar is the biggest part, but there's also the other currencies in there. So right now, where we are, central banks have needed to print and expand the money supply because they were not getting the inflation that they wanted to, that they thought was healthy and needed. And what that told us was, wow, the deflationary pressure is very strong here. If we're doing 8 years, 10 years of QE, where we're expanding money supply, easy money, and we can't get the inflation that the central banks are targeting at 2%, it just shows you how truly deflationary the pressures were that were underlying. So they need to do a lot more printing, a lot more liquidity flooding. And all of a sudden, when it does get to the point where they're getting the inflation that they want, it's very hard to exactly pinpoint it. So then it overshoots the 2% target. Now we're getting 3, 4, 5%. And then they're in this position where maybe they're forced to change and rein it in, and you can get some shocks to the system. But Bitcoin in general, there is a need for scarce assets. Gold has been around forever, right? The fact that gold over the last 3 months, 6 months has underperformed Bitcoin, it doesn't mean that the need for gold and the use case for gold is no longer there, and then it's no longer valuable when you're looking at gold against fiat currencies. Bitcoin was created, the structure of its emission schedule, it was created after gold, right? It was modeled after gold, just mathematically. They tried to do it mathematically according to how gold really is mined and comes into the system. So I think that Bitcoin will see ebbs and flows in the market based on what's going on the macro scale and what central bank policy is established. But I do think that it's very important to think about where we're going to come from. If we're $250,000 at that time, 100,000 comes back, keeps going. We don't really know, but it surely will be affected greatly by future policy.
Mm-hmm. And, I think that's a point that a lot of people don't realize. What is money? Historically, money wasn't fiat. It became fiat 1979, once, I believe it's 1979, the Bretton Woods, when they took it off the gold standard. And so people don't realize that the piece of paper they hold, what gives it value. And so, if they were to understand that, they were, to be educated and explained, this is what gives a dollar value, this is what gives Bitcoin value, this is what gives gold value, this is what gives corn value. These are all different assets. They all get value from different places. And so people assume money is value. Everything else just gets exchanged for money, but that's not really how it works. So,
Right.
I think that although these are troubling times, tough times for a lot of people, people are learning, people are opening up their eyes. They have more access to education, more access to this understanding that is crucial to really making them educated traders, educated investors, and financially responsible people, which I think is very good.
Yeah.
Now, you traded commodities, like you mentioned, corn, wheat, soybeans, and wheat. So
Yeah.
a very, very, very sexy industry, I'm sure. So trading commodities is different from trading equities or other markets. And I wonder, now that we're able to, you're starting to see this a little bit in the space where people are digitizing assets onto a blockchain. And they're utilizing these assets to trade them, wrap them up, and trade them in all different types of ways. I want to ask you, because obviously you're an expert in this matter. Can you see an advantage to digitizing and trading some of these commodities on a blockchain as opposed to just the traditional markets where they're traded right now, which are already essentially digital?
Yeah, for sure. I think one of the benefits that can improve dramatically is the settlement process. Settlement is it's at the core of trade. And it used to get done in back offices between banks, between trading firms, clearing firms. And now settlement can be done on a trustless ledger, right? Where it's public, it's open. We can all see every single trade, every transaction, everything that's done for everybody to see. I think what we come into when we're dealing with commodities, settlement is done in a few different ways, right? The futures that I traded at the Chicago Board of Trade, which was now the CME, were physically settled. So you hear those stories about, well, I own some corn contracts, and am I going to get corn delivered at my house in the front yard? They're just going to pull up a truck and dump the 5,000 bushels of corn. Well, no, there is a system in place. You have to be able to accept delivery. And so that part of it makes the commodity trade purely digitized and on blockchain different. There's a few more steps, but a lot of instruments and derivatives are cash settled. So it will settle to an index or a settlement price. And then instead of exchanging corn, soybeans, oil, wheat, gold, you would just exchange the money. And you might be able to go to a warehouse, closer to where you are if it was a physical commodity. But everything will eventually be, I believe, settled, digitally settled immediately on the blockchain, using these technologies that are new. We're very early in that stage, but it works in these digital exchanges that we see in the crypto space. They're exchanging billions and billions of dollars of assets a day, and it's working, and it's working every day. So I think we are going to see that take place. There are nuances in markets, and you do need this down to the core trust from the biggest players, the biggest liquidity providers. You read names like Citadel, right? Like Jump Trading, like the big banks. When things go wrong and when we see markets collapse and liquidity dries up, the biggest thing that the Federal Reserve and the US Treasury, what they need to do is they need to make the biggest liquidity providers feel confident. We are here. We're not letting this thing collapse. We are going to put more money into the system. Please, what do you need to go make markets again? Put bids and asks, let people transact. If people need to get out, make a market so they can get out. If others want to get in, make a market so they get in. The biggest players, they need that confidence that, okay, I will go do my job. I'll go provide liquidity, but Fed, you tell me, like, we're not letting this thing collapse, because why am I going to be in there? I'll just wait till the dust settles and come pick up the pieces. Yeah. So it is that trust. And that's one thing with crypto and with Bitcoin. We have the network, but there is no central entity. There is no, real Satoshi back there who's like, okay, guys, we're all good. We've got reserve here. Like, that doesn't exist. It is a collective. It is a network. So it's not infallible. There are things that we need to work through. It's not just ready to like set it and forget it. And we're not there, but eventually we hope to get there.
Right. And we're starting to see that with the growth of DeFi. The automated market maker. You're a market maker. Before getting interested in crypto, I never even heard of a market maker. I had no idea what it was. But because of DeFi and looking into it, and I learned a lot of how the markets work, and we're seeing this rise of automated market makers. And if that's successful, if the technology there proves itself, with, hey, anyone who has liquidity, they could provide liquidity, be there a market maker, and be rewarded for it, gain all those awards that traditionally the traditional market makers have. Can you see that actually transferring over to traditional markets where, hey, opening up market making to everyone, and that actually working?
Absolutely. It can work. But one thing we have to remember, market making and being a liquidity provider, it sounds glamorous, right? I'd love to be a professional market maker, liquidity provider. Look, they're making so much money. What we don't see is that there is a graveyard that goes on for miles and years of liquidity providers and market makers who got taken out on a stretcher, right? Like, literally, they didn't survive. Market making, liquidity providing, it is not easy. It is complicated. Markets are complicated. You can also be the smartest, most diligent market maker, and you can also lose everything.
What's the risk? What's the risk posed to market makers and liquidity providers?
Well, let's just use something kind of basic here. A futures contract, right? A corn futures contract. And let's say you're a market maker who, you're a member of the exchange. You pay your dues and you get lower transaction fees than everybody else, because you're there to perform a service. You're there to provide a bid and an ask. And back when I started at the floor of the CBOE and the options market making pits, standing in the pit, I needed to make a two-sided market. And if it was a regular market conditions, there were limits to the width of my market. If the option was under $1, let's say, I could only make my market $0.25 wide or $0.50 wide. So I needed to stand there when a broker came in and he asked, how is this contract? I needed to give a price where I was willing to buy that contract and a price where I was willing to sell it at the same time. So when you're a liquidity provider in the truest sense and you're providing a bid and an ask, you are risking. Let's say I provide a bid and an ask and the broker says, okay, I'll buy those. I'll buy 1,000. I'll be like, oh, okay, I'll sell you 100 of those. Right. And then he'll say, well, where can I buy more? Right? So then you make another market. Well, okay, I sold you these at $1. Now you got to pay me $1.50 for another 100. And he says, I'll buy another 100 at $1.50. Where can I get more? And then you're like, okay, now you'll have to pay me $5. Seems like you've got a lot of these to buy, and I don't have inventory. So now, if I don't have inventory of that, now I'm short a couple hundred of these things. When am I going to get those back? What if that thing goes from $1 to $100 in 5 minutes because the Robinhood buyers of the world just come in and buy all of this stuff up? That's real risk. If I don't have capital with my clearing firm to cover what I've lost just in paper, in unrealized losses, I would have to close my position. And so that happens in markets. That it's the beauty of being a market maker in the ideal sense is that I can buy my bid and sell my offer all day long. There's a spread there. I collect my spread. I go home and come back the next day. That's not really how markets work, though. You get moves that they can trend and they go back and forth. So you can get into a position where you're down a lot of unrealized money. And with some of these AMMs we see in the liquidity pools, there's this thing called impermanent loss.
Yep.
Well, impermanent loss can become permanent when you pull your money out of the pool. And that's the same way with unrealized P&L as a market maker. Unrealized P&L becomes realized, and it can be quite painful. And that's really what we're dealing with. The systems, you know, there's some people have much better technology, so they have an advantage. But market making, liquidity providing, extremely complicated and extremely capital intensive. It takes a lot of money that you need to hold with your, whether it's the exchange, whether it's the clearing firm. So you got to know both sides of it. But I do absolutely believe that AMMs and kind of opening up market making and liquidity providing to everybody, that's a trend that's going to continue, but it's not all wins. There's pretty much as much loss as wins going on in the market. So
and that's what people have to realize whenever investing or trading. There's a reason that anything has a high reward. It's because there's a high risk. You know, the risk and rewards usually and should, in a fair market, in a correct market, should usually be mirroring each other. So always trade responsibly. But as we spoke, and anyone listening to this conversation could realize that markets are very complex, and there are a lot of complex trading tools. But that's what I actually liked about Hxro in your offerings, because you guys are actually offering what in reality could, in the back end could be very complex trades, but you guys make it very fun, very approachable. You want to kind of go through kind of what kind of trades and offers you guys provide to customers?
Sure. One thing we saw when we got into crypto was these great instruments, the perpetual swap, which is just really a futures contract with no expiration date. But how it functions is there is a funding mechanism that works to kind of moderate the market. If it gets too heated up, too many people are buying this contract, then the cost of holding that contract increases, which then brings in sellers of that contract to kind of moderate it. Because if this perpetual swap on Bitcoin, it tracks the true Bitcoin price, but it's a derivative, right? You're not owning any real Bitcoin. So the perpetual swap, which BitMEX, it really was a novel instrument, but it also opened up the idea of leverage trading to people. And leverage trading it's a very powerful weapon, and it can be deadly. And by deadly, I mean you can lose all your money pretty quickly if you're not seasoned, if you really don't know exactly how these things work. So with Hxro, with our first products, we set out to give that same, people like trading the perpetuals because it's that rush. It's chasing, using 100x leverage. It's chasing a rush. It's as much emotional, psychological as it is to make money. So what we tried to do is we were very, very intimately aware of the emotional and psychological aspects of trading, from standing in the trading pit, right? From sitting in front of 8 screens, watching the markets go crazy when you're interacting with hundreds of instruments at a time. We were intimately familiar with that. We wanted to create some products that offered a blend of both the excitement, the energy, the electricity of these markets, but without the high leverage, and which can prove to be deadly for a lot of people. So our first product was a parimutuel contract where no leverage, you can only risk what you put in, and it's basically the winners are paying, they're collecting from the losers. So if you think Bitcoin is going to go higher in the next hour or next day, you can take a position that it's going to moon. We called it moon for crypto. And the people who think it's going to go lower, who are taking a position on rect, whoever is right, they collect the pool. So it was a peer-to-peer contract, predefined risk. You know, if I put $10 into this, that's the most I can lose. And this idea where you can get the emotional, the excitement, you can experience these markets with only risking a tiny bit and without using leverage. And so when we came up with these pool-based contracts on a standardized time frame, which lined up perfectly with the chart, right? These candle charts, the trading view charts that we all stare at all day, that is the biggest support tool for traders. They want to know where prices you can look at it in a 1-minute time frame, 5-minute, 15-minute, hourly. So we aligned our contracts perfectly with the chart and let people say, okay, is it going to be green or red? Is it up or down, moon or rect? And peer-to-peer, we're going to play against our peers. The high frequency guys don't have an advantage. That was the basis for our first product, Moon Rect. We had the idea, and the one thing that crypto showed us was, you have an idea, build it, build a prototype, put it in people's hands, see how they like it, get their feedback, and iterate. And that's what we did.
And that's awesome. I mean, I really, it's fun. I think that's what's needed in the space, because like we've mentioned, and anyone listening to this conversation, there are such powerful tools. Markets are complex, and there are tools for the advanced trader. But I think it's really great that you are also, people like you at Hxro are offering a way for even new people who don't necessarily have the knowledge base to really deal with the professional swaps and options and all these things. Let them get exposure, let them understand the risk, but also let them get the reward. So that's all the time we have here, Rob. But I do appreciate you really giving our viewers a little insight kind of into how the markets work, your views on both quantitative easing as well as the potential for blockchain and Bitcoin. It was really a pleasure speaking to you, Rob. I do appreciate taking the time. And for all of our viewers here at Reimagine 2021, I'm Yonah Hochhauser. Thanks for watching.